1 California Medi-Cal asset rule adjustments. There's another quiet shift happening in 2026 that many seniors still don't fully understand, and it involves Medi-Cal eligibility rules. Over the past few years, California has been gradually changing asset limits for seniors applying for Medi-Cal long-term care coverage. In simple terms, the amount of savings you are allowed to keep while qualifying for Medi-Cal has expanded significantly. Previously, strict asset caps meant many seniors had to spend down large portions of their savings before qualifying. Now, California has moved toward eliminating traditional asset limits for many applicants. Why does this matter? Because long-term care costs in California can exceed $100,000 per year. Without proper planning, even middle-class retirees can see lifetime savings drained rapidly. And the updated eligibility structure means you may qualify with more savings than before. Planning options have expanded. Families have more flexibility, but here's the part that requires attention. Income rules still apply, and estate recovery rules still exist. Meaning, just because asset limits change does not mean planning is unnecessary. If you or your spouse might need long-term care in the future, 2026 is a critical year to speak with an elder law attorney or Medi-Cal planning specialist, because timing can dramatically change outcomes. A single year of poor planning could cost tens of thousands. Strategic planning could preserve a lifetime of work. 12. Senior property insurance market shifts. Home insurance in California has become one of the biggest financial stressors for older homeowners. And in 2026, insurance market changes are directly affecting seniors. Several major insurers have adjusted underwriting standards, reduced new policies, or increased premiums due to wildfire risk exposure. For seniors living on fixed incomes, a 25 to 40% premium increase can feel overwhelming. But here's what many don't know. California has expanded consumer protections requiring clearer disclosure when policies are non-renewed. Additionally, the FAIR Plan, the state's insurer of last resort, has expanded coverage limits. If your policy was recently canceled or your premium jumped significantly, don't assume you have no options. Shop multiple providers. Review mitigation discounts for fire-resistant roofing, cleared defensible space, updated electrical systems. Small home improvements could reduce premiums long-term. In 2026, once insurance is no longer set it and forget it, it requires annual review. 13 banking changes for joint accounts and trusts. Another update affecting many retirees involves how banks handle joint accounts and living trusts. Financial institutions are tightening documentation requirements. If your trust documents are outdated or incomplete, you could face delays accessing funds, especially in emergency situations. Many seniors created trusts 10 to 20 years ago and never updated them. In 2026, banks are increasingly requiring updated certification of trust, clear successor trustee documentation, proof of authority. Without this paperwork, accounts may be temporarily frozen after the death of a spouse, which creates immediate cash flow problems. If you have a trust, review it this year. Confirm beneficiaries are current. Confirm trustee information is accurate, because estate planning isn't only about after death, it's about access during crisis. 14. Expanded senior transportation benefits. On a more positive note, 2026 brings expanded transit discounts in several California counties. Public transportation agencies are increasing senior fare reductions and expanding paratransit eligibility. If driving becomes more difficult, affordable alternatives are improving. Many seniors qualify but never apply. Reduced transit passes can cut monthly transportation costs dramatically, and some counties now offer free shuttle services for medical appointments, discounted rideshare partnerships, expanded ADA accessible options. Mobility equals independence, and 2026 offers more options than many realize. 15. Social Security overpayment recovery policy adjustments. While Social Security is federal, California seniors are impacted by changes in how overpayments are handled. Recent federal adjustments limit how aggressively benefits can be clawed back if overpayments occur. However, errors still happen. If you receive notice of overpayment, do not ignore it. Appeal rights exist, payment plan options exist, but deadlines are strict. Review your annual Social Security statement carefully. Ensure income reporting is accurate. One overlooked letter could result in withheld benefits for months. Stronger, extended closing, deeper and more emotional. Let's pause for a moment. Take a breath. Because when you look at all of this together, one truth becomes clear. 2026 is not about dramatic headlines, it's about quiet shifts. Oh, small adjustments, eligibility tweaks, documentation changes, new protections, new responsibilities. Individually, each law may seem manageable, but combined, they shape your financial stability, your housing security, your healthcare flexibility, your independence. The difference between a peaceful retirement and a stressful one often comes down to awareness. No one is going to call you and explain these changes personally. No letter will summarize everything neatly. That's why staying informed matters. Ask yourself, have I reviewed my property tax options? Have I checked my Medicare coverage? Have I updated my trust documents? Have I confirmed my utility discount eligibility? Have I spoken with a tax professional about withdrawals? Retirement is not just about what you saved, it's about what you protect. And in 2026, our protection means action. A 30-minute phone call, a scheduled appointment, a document review, a policy comparison. Small steps now prevent major financial surprises later. You worked decades to build stability. Now the goal is to preserve it. Stay informed, stay proactive, stay empowered. Because peace of mind in retirement doesn't happen by accident. It happens by preparation. And 2026 is the year preparation truly pays off. 6. Senior savings account interest and state tax interaction. There's something subtle happening in 2026 that many retirees may overlook, and it involves interest income. With interest rates fluctuating over the past few years, many seniors moved money into high-yield savings accounts, CDS, or money market funds. That sounds smart, and often it is. But here's what's easy to forget. Interest income is taxable at the state level in California. Even if your Social Security isn't taxed by the state, interest income from savings accounts, certificates of deposit, and certain bonds may increase your overall taxable income. Why does this matter in 2026? Because higher savings yields can push total income above certain thresholds. That can affect eligibility for assistance programs. It can influence Medicare premium surcharges, IRMA at the federal level. It may increase your state tax liability. Let's say you earned $8,000 more in interest this year than last year. That might feel like a win, but if it pushes your adjusted gross income into a higher bracket, you may lose eligibility for utility discounts, certain local senior property programs, pharmaceutical assistance, premium adjustments. The lesson: growth is good, but tax planning matters. Before moving large sums into interest-generating accounts, consider speaking with a financial advisor about tax-efficient withdrawal sequencing, municipal bond options, strategic timing of interest realization. Small shifts in planning can preserve more of what you earn. 17 California estate recovery clarifications. Many seniors believe Medi-Cal estate recovery was eliminated. That's not entirely accurate. California significantly narrowed estate recovery rules in recent years, but they still apply in certain situations. In 2026, clarification guidelines emphasize, recovery applies primarily to long-term care services received after age 55, and it typically applies only to assets that pass through probate. Why is this important? Because homes held in properly structured trusts may avoid probate. Beneficiary designations matter, joint tenancy structures matter. Families who assume the state won't touch anything could face surprises. Estate recovery doesn't affect everyone, but if you receive long-term Medi-Cal benefits, planning still matters. A simple consultation with an estate planning attorney could protect your home, protect family inheritance, avoid unnecessary probate exposure. Planning ahead costs far less than correcting mistakes later. 18 Senior employment and part-time work impact. More seniors are working part-time in retirement. Not because they have to, but because they want flexibility, social engagement, or supplemental income. In 2026, updates to income reporting and payroll tax compliance are creating new considerations. If you're collecting Social Security before full retirement age and working part-time, income limits still apply. Exceeding the annual earnings threshold can temporarily reduce benefits. Additionally, gig work income, rideshare, consulting, tutoring, online sales must be properly reported. Failure to report income accurately can trigger overpayment notices, which, as we discussed earlier, can lead to repayment demands. Working in retirement can be rewarding, but it requires careful tracking. Keep records, understand income thresholds, plan earnings strategically if drawing early Social Security. Yes, because enjoyment should not create avoidable penalties. 19 California home sharing and ADU regulations, accessory dwelling units, ADUS, sometimes called granny flats, have become increasingly popular. Many seniors are building ADUs to generate rental income house caregivers, provide space for adult children. In 2026, California continues expanding ADU-friendly zoning laws. Permitting processes are streamlined, but tax implications and rental income reporting still apply. If you rent an ADU, rental income must be declared. Property tax reassessment rules may apply depending on structure changes. However, strategically done, an ADU can offset rising living costs, provide intergenerational housing flexibility, increase property value. Before construction, Audzi consult on a tax professional, a local zoning office, a contractor familiar with senior accessible design. The opportunity is real, but planning protects profit.